Most traders think waiting is patience. They're wrong. Waiting without a plan is procrastination wearing a mask. Jesse Livermore learned this the hard way, and it cost him 6 figures before he cracked the code. The difference between a professional trader and an amateur isn't supernatural foresight or secret market access. It's something far simpler and infinitely more dangerous, the ability to distinguish between two states of mind that feel identical but produce opposite results. One state destroys accounts. The other builds empires. Here's the brutal truth that most trading educators won't tell you. 68% of profitable setups are missed because traders hesitate at entry. Not because the setups don't exist, not because the trader lacks the capital, but because the psychological gap between seeing a signal and executing on it has become an unbridgeable chasm. A trader sees the pattern form, the tape confirms the direction, everything points toward entry, and then doubt arrives. Quiet, insidious, reasonable-sounding doubt. The trader hesitates. He tells himself he needs more confirmation. He waits for the price to move a little further. He looks for one more technical indicator to align. By the time he's decided, the move has already begun. The best part of the rally is behind him. The price gap has widened. The risk to reward has deteriorated. The amateur trader watches from the sidelines, nursing regret, telling himself he'll catch the next one. But he never does. The next one comes and goes. Then the one after that. Meanwhile, professionals are already 3 trades deep into profitable positions, compounding their edge. This is the paradox that kills retail traders. The more you think about a trade, the less likely you are to take it. The more confirmation you demand, the more you miss. The more you wait, the more hesitation becomes your default mode. It becomes a habit, a personality trait, a trader identity built on the foundation of missed opportunity. But here's what actually separates professionals from amateurs, and this is the insight that changes everything. Professionals execute before they feel ready, not recklessly, not blindly, but with a kind of disciplined conviction that amateurs can't access because they're still waiting for permission. Permission from the market, from their analysis, from some external validation that says now it's safe. Professionals know that safety is an illusion. The market never feels safe at the entry point. If it does, you're already late. Livermore didn't wait for certainty. Certainty is a trap. Certainty means the move has already started without you. Certainty means everyone else has already decided, and the easy profit is gone. What Livermore waited for was confirmation, something entirely different. Confirmation is the market responding to your hypothesis. It's price action that validates your read. It's volume that backs up the signal. It's momentum that proves the direction. And when that confirmation arrives, professionals don't hesitate. They move. They execute with ruthless speed. The difference between waiting for certainty and waiting for confirmation is the difference between a blowing up account and a 7-figure portfolio. Certainty paralyzes. Confirmation activates. For decades, maybe longer, traders have been conditioned to think about market entry in binary terms. You either commit the full position size, or you don't commit at all. All in or all out. This all-or-nothing mentality is seductive, because it feels decisive. It feels like you're taking control. But it's actually the most dangerous way to approach position building. One bad entry at full size, and you're immediately in drawdown. Your psychology fractures. Panic sets in. You exit early, crystallizing a loss on a trade that would have worked if you'd just held. You blow $500 to $2,000 in capital on a single decision made under emotional duress. That binary thinking, that all-or-nothing approach, is why so many blow accounts. But what if entry didn't have to be binary? What if there was a method that allowed you to enter strong without committing all at once? What if you could scale in methodically, with rules so tight that each successive micro-entry actually reduced your portfolio risk instead of increasing it? What if the world's greatest tape reader had figured out a way to move fast and stay safe simultaneously? He did. And it's simpler than you think, but only if you understand why amateurs instinctively fear it. The hidden pattern in Livermore's personal journal reveals something that almost no trader applies in practice today: the 1-3 scaling formula. Now, when you first hear that phrase, your mind probably jumps to pyramid buying. or averaging down, or some version of throwing good money after bad in hopes of salvaging a losing position. But that's exactly what this method isn't. It's not pyramid buying in the traditional sense. It's not averaging down into weakness. It's something far more precise and far more powerful. A disciplined 3-step entry protocol that lets you build position size after the trade proves itself, not before. This distinction is everything. It flips the entire conventional wisdom about position building on its head. Think about how most traders approach entry. They analyze a setup. They wait for a signal. They make a decision. And then, in that moment, they commit their maximum intended position size all at once. They put all their eggs in one basket and hope the basket doesn't break. But Livermore's method works differently. He enters a small probe position first, just enough to test whether the market agrees with his read. If it does, if the tape shows strength and confirmation arrives, he adds a second tranche. Then a third. By the end, he's built the same total position, but he's done it in a way that turned every dollar into evidence, not hope. Every entry point was a question. Every price movement was an answer. By the end of this deep dive, you'll see exactly how Livermore executed this method, why it works with such consistent precision, and how professional traders today are using these exact same principles to enter fast without ever risking like an amateur. You'll understand the 3 confirmation gates that separate winning entries from gambling. You'll learn the psychology that makes smaller individual positions create larger tolerance for market volatility. You'll see the real-time decision tree that professionals use to decide in seconds whether to add, wait, or cut. But first, before we get into the mechanics and the rules, you need to understand what most traders fundamentally get wrong about position sizing. You need to see why the binary approach feels right, but destroys accounts. You need to understand the psychological trap that hesitation creates. Because once you understand what you're doing wrong, the 1-3 method won't just be a technique you memorize. It'll be a way of thinking that changes how you approach every single trade for the rest of your trading career. Let me paint a scene. It's 1924. Livermore sees a stock moving with unusual strength. The tape confirms the pattern. His conviction builds. An amateur trader in the same room, a man with equal capital, equal access to information, equal market knowledge, commits 100% position size immediately. Entire stake, maximum leverage, all on the first entry. No hesitation, no doubt, just pure unfiltered conviction and speed. He enters with 12 contracts, when his full intended position is 12 contracts. He's all in from the opening bell. Within 3 minutes, something shifts. Price stalls. The momentum that looked so obvious moments ago suddenly evaporates. A reversal candle forms on the tape. The bid weakens. Sellers appear where buyers dominated seconds before. The trade is wrong. Not slightly wrong. Clearly, undeniably, mechanically wrong. The market has spoken. The amateur is down 2% instantly. That's $240 on a $12,000 position. Not catastrophic in absolute terms, but devastating psychologically. Panic floods in like water through a broken levee. His entire conviction inverts in seconds. What felt like a sure thing now feels like a disaster waiting to happen. His mind races through worst-case scenarios. What if this turns into a 5% loss? What if he holds and it becomes 10%? His stop loss is 30 pips below. That's still possible. That's still likely. He can't tolerate this feeling. He exits at market, crystallizing the loss immediately. 2% gone. Capital destroyed. Confidence fractured. But here's the part that haunts him. The trade would have worked if given 2 more minutes. If he'd held. If he'd waited. If he'd believed in his original analysis, the reversal would have been nothing but a minor pullback. Price would have recovered. The move would have continued. He would have been profitable. Instead, he'll spend the rest of the day, and maybe the rest of the week, replaying that exit decision, torturing himself with what-ifs. He never gets those 2 minutes, because he anchored his entire psychology to one binary entry decision. All his capital was deployed at maximum uncertainty. One adverse tick and his entire position became intolerable. Livermore watched this happen countless times. He saw it happen to other traders. He experienced it himself in his early career before he cracked the code. And he understood something fundamental. The all-or-nothing entry isn't bold. It's reckless. It's not confidence. It's gambling. It commits maximum capital to maximum uncertainty, and then it relies on the trader's psychological fortitude to hold through the inevitable volatility. Most traders don't have that fortitude. Most traders panic. Most traders exit exactly when they should hold. Livermore didn't fall for this trap. Here's why. He had a different method entirely. The 1-3 formula works like this, and it's deceptively simple in its elegance. Entry is divided into 3 distinct stages. Each stage represents exactly 1/3 of your intended final position size. Nothing more, nothing less. The first 1-3 is your probe, small enough to test whether the market actually agrees with your read, but large enough to matter psychologically, so that you're engaged and paying attention. If price continues moving in your direction and the trade starts working, you don't sit idle and watch from the sidelines. You deploy the second 1-3. You're adding to a winner now. Your average entry improves. Your conviction strengthens, because the market is confirming your thesis in real time. If that confirms, if the momentum persists and price structure validates the move, you complete the position with the final 1-3. The genius of this structure is profound. Each stage buys you confirmation, not hope. That distinction is the entire game. An amateur trader approaches entry like this. Is this trade going to work? He commits capital based on the answer he wants. He wants it to work, so he decides it will work, and he commits accordingly. He's making a bet based on his desire for it to be true, not based on market evidence. A professional trader approaches the same setup entirely differently. What needs to happen next to prove this trade right? He doesn't commit full capital based on his analysis. He commits full capital based on what the market actually does. He commits capital based on what actually happens, not on what he hoped would happen. The 1-3 method forces you to be a scientist, not a gambler. It transforms entry from a binary guess into a testable hypothesis. Entry 1 poses a question to the market. Is this direction real? Entry 2 confirms the signal. Is the follow-through authentic? Entry 3 executes the full conviction. Has this trend established itself? You're not betting. You're testing. You're not gambling. You're gathering evidence. Here's the practical mathematics. If your full intended position is 10 contracts, you start with 3. You place that probe position at your entry point. Let's say that moves 50 pips profitably in your direction without hitting your stop loss. That's confirmation. You add another 3 contracts. Now you're at 6 contracts total. Your average entry price is better than if you'd bought all 10 at the first level, because your second entry is at a higher price, but you're only adding because the trade worked. If that second tranche continues to work, if it confirms the pattern, you add the final 4 contracts. Now you're at your full position of 10. What just happened? Your average entry is better. Your conviction is real, built on actual market evidence, not hope, and your psychology is protected. You never committed maximum capital to maximum uncertainty. You committed 1/3 capital to a hypothesis. Only when that hypothesis was validated did you add more. Only when the trade proved itself did you scale up. Most traders think this is slow. They think you're leaving money on the table. They think you're overthinking it. Professionals know it's fast, because you're only adding size when the trade proves itself. You're not adding to hope. You're not adding to theory. You're adding to results. The beauty of Livermore's method is this. When the first 1/3 is right, you're not sitting on fumes. You're not nursing a small position and praying it works. You're sitting on momentum. You entered at the right level. Price moved in your direction. The market validated your read. Now you have conviction, capital, and momentum, all working together. And momentum has a magnetic quality. It attracts the second and third entry almost automatically. When price continues to move, when volume expands, when the structure breaks through resistance, adding the second tranche feels natural. Not forced. Not desperate. Natural. And the third tranche follows the same pattern. Contrast this with the amateur who entered all 10 contracts at once. When price stalled momentarily, he panicked and exited. If he'd used Livermore's method, he would have exited just the first 3. A smaller loss. less psychological damage, and he'd be alive for the next signal. He'd have capital preserved. His account would still be functioning. Most importantly, his mind would still be functioning. He wouldn't be drowning in regret and self-doubt. He'd be ready for the next opportunity. This is the hidden advantage of the 1-3 formula. It doesn't just improve your average entry price. It doesn't just reduce your downside per position. It protects your psychology. It keeps your mind clear. It lets you make rational decisions under pressure. It turns trading from an emotional roller coaster into a systematic process. And that systematic process, repeated over hundreds of trades, compounds into wealth that amateurs can't even imagine. The contrast is sharp. Amateurs see 1-3 scaling as slow, as conservative, as leaving money on the table. Professionals see it as the only way to be fast safely, the only way to move with conviction without risking recklessly, the only way to build real trading wealth instead of gambling it away. Scaling in without rules is just throwing money at the market and hoping it sticks. It's roulette with an extra step. It's gambling dressed up as strategy. Livermore wasn't a hope trader. He wasn't a gambler. He was a scientist. Every single 1-3 entry he made was governed by 3 non-negotiable confirmation gates. These gates weren't suggestions. They weren't preferences. They were absolute rules that he would not violate under any circumstance. Understanding these gates is the difference between a 1-3 scaling method that works and a 1-3 scaling method that bleeds capital slowly and painfully. Let's talk about the first gate in detail, price structure. This is foundational. This is where everything begins. When you enter the first 1-3, you're not buying strength blindly. You're not buying because the price is going up and you're afraid to miss the move. That's how amateurs get trapped. You're buying after a retrace into support. You're buying at a specific, identifiable level where prior demand exists. Livermore watched the tape religiously, obsessively really. He spent hours staring at ticker symbols, understanding how big money moves in and out of stocks. He knew that the strongest entries happen when price retraces into a prior demand zone. This isn't just any support level. This is a level where big money bought before and held their position. This is a level where institutional money accumulated. When price returns to that level, and this is crucial, without breaking it, that's your first entry point. That's your probe location. The geometry here is important. The first 1-3 enters at or very near support. You set your stop loss 2 ticks below the prior swing low. 2 ticks. Not 1. Not 5. 2. This isn't arbitrary. This isn't a guess. It's geometry. It's precision. The swing low defines the level where the prior selling pressure became too intense for buyers to hold. If price breaks below that level on your second entry, the entire setup is invalid. The market has rejected the support. The hypothesis is wrong. You exit the entire position. Your stop loss is your evidence that you were wrong. But here's where amateurs break the system immediately. They add the second 1/3 the moment price rises. Any pop, any bounce, any little up move, and they're throwing the second tranche at the market. Wrong. This is the entire reason most traders fail at scaling strategies. The second 1/3 only enters when price breaks above the swing high that caused your initial retrace. That breakout is your confirmation. That breakout is the market saying the selling is done, and buying is now in control. Until that breakout happens, you're still in test mode. You're still in hypothesis mode. You stay small. You wait. Think about what this does psychologically. Your first 1-3 is small enough that normal market volatility doesn't shake you. Price dips slightly. You don't panic because you're only risking $60 instead of $500. Price bounces. You're still waiting. You're not adding on a 1-tick move. You're waiting for structural confirmation. You're waiting for price to prove that it can actually break through the level that previously caused a reversal. Only when that happens, only when price closes above the swing high, do you add the second tranche. Now you're adding to a breakout. Now you're adding to proof. The second gate is volume. Livermore called it the tape, but the principle is identical to what we understand as volume today, position sizing scales with market participation. This is non-negotiable. When the first 1-3 enters at your support level, Volume should be rising, not declining. Rising volume at support is the market saying demand is real, and it's accelerating. Declining volume at support is the market saying this bounce is weak, and sellers are still in control. Most traders ignore this. They add anyway. They think if they just throw enough capital at it, the trade will work. It won't. The tape doesn't lie. Volume doesn't lie. When you add the second 1/3 on the breakout above the swing high, volume should expand again. This is the critical part. A breakout on declining volume is a trap. A breakout on contracting participation is a false signal. Amateurs see price break above resistance and immediately add. Professionals check the volume first. If volume shrinks on the breakout, professionals wait or reduce. They don't add. They understand that a breakout without volume participation is likely to fail. They understand that real structural change requires real market participation. Volume is the jury's verdict. If the jury isn't voting, the verdict isn't legitimate. The third gate is time. Livermore was fanatical about this, almost obsessive. Each stage of the 1-3 entry required at least 2 to 3 candles, or bars in his era of confirmation before adding the next tranche. Why? Why wait 2 or 3 candles when you could add immediately? Because a 1-candle pop is noise. A 1-candle spike is natural volatility. A 1-candle move proves nothing. But 3 candles of consistent movement in your direction, 3 candles of sustained price action, that's a shift in structure. That's the market changing its behavior. That's time validating your read. Think about the psychological advantage here. A 1-candle move feels urgent. It feels like I need to act now or I'll miss the move. That urgency is exactly what kills traders. They act on incomplete information. They add 2 moves that reverse in the next candle. They scale in too early and too aggressively. Livermore's rule, wait for 2 to 3 candles, forces patience. It forces discipline. It ensures that you're only adding when the market has demonstrated sustained directional bias, not just a momentary bounce. Here's a real trade scenario that illustrates how these 3 gates work together in sequence. You're watching a stock. Let's call it X size. It's been in a downtrend. It falls to a prior support level, a level where big money has bought before. The volume on this decline is increasing. Sellers are capitulating. The first gate is triggered, price structure at support with rising volume. You enter the first 1-3. 3 contracts. Stop loss 2 ticks below the swing low. Risk $60. You wait. First candle closes. Price holds support. Volume was strong. No follow-through, but no rejection either. You're still in test mode. Second candle closes. Price holds again. Still no breakout above the swing high. Still in test mode. On the third candle, something shifts. The stock breaks above the previous day's high. Volume spikes. The tape shows aggressive buying. This is your second gate, structural breakout with volume expansion. You add the second 1-3. 6 contracts total. Your average entry is now slightly better because you bought the second tranche higher, but you're only adding because the market proved the setup. You wait again. Another 2 to 3 candles. Price is accelerating higher. The momentum is building. New resistance forms, a level that previously capped the move. On the third or fourth candle, price breaks above that resistance too. Volume expands again. New highs are being established. The third gate is triggered, multiple candles of sustained structure with expanding volume. You add the final 1-3. 9 contracts total. Now you're fully positioned. But you're fully positioned only after the trade has proven itself 3 times. What just happened here? You scaled from 3 units to 6 to 9, but you never added to a falling trade. You never added to a stalling trade. You only added to accelerating moves. Your average entry price is mathematically superior to someone who bought 9 contracts all at once at the first support level. You're more profitable because you entered better. You're more profitable because you let the market validate your thesis before deploying more capital. This is why Livermore's average entry beats simple buy and hold by such a wide margin. He wasn't guessing. He wasn't gambling. He was confirming. Every single entry was validated by 3 independent gates. Price structure proved the level mattered. Volume proved the participation was real. Time proved the movement was sustained, not noise. The amateur trader sees a stock bounce and thinks I should add. The professional sees the same bounce and thinks I need 3 candles of proof before I add. The amateur adds to hope. The professional adds to confirmation. Over 100 trades, over 1,000 trades, this difference compounds into a chasm. The amateur blows up. The professional builds wealth. And it all comes down to these 3 gates: structure, volume, time. That's separate evidence from hope, confirmation from conviction, real trading from gambling. Here's something almost nobody talks about when they discuss position sizing and scaling methods. The real power of 1-3 scaling isn't better entry price. It's not even faster execution. The real power is better stops. Better stops mean better psychology. Better psychology means better decisions. Better decisions mean surviving long enough to compound wealth. This is the hidden architecture that separates professionals from everyone else. When you're building position in thirds, each micro position gets its own micro stop loss. This sounds simple. It sounds obvious. But what it actually does to your brain, to your nervous system, to your ability to think clearly under pressure, that's where the magic happens. It changes everything about how you experience risk. It changes everything about how you make decisions. Let me contrast 2 traders in the exact same market, trading the exact same setup with the exact same capital allocation. The amateur trader buys a 10-contract position all at once. His intended full position is 10 contracts, and he deploys all 10 immediately at his entry point. He sets his stop loss 50 pips below the entry. That's a hard number staring him in the face. He's risking $500. 500 actual dollars. That's rent money. That's groceries. That's a car payment. It's terrifying. His brain knows this. His nervous system is flooded with cortisol. He's in a state of high alert, high stress, high anxiety. Then price dips. Not much. Just 25 pips. He's now down $250. He feels half the total risk in his gut. Panic floods in. His mind spirals through worst-case scenarios. What if this continues? What if the entire 50 pip stop is hit? What if it goes beyond that? He can't tolerate this feeling. The anxiety is overwhelming. So he exits. Right there. At the worst possible time. He crystallizes a 1% loss on a trade that would have made 3% if he'd just held for 2 more minutes. He exits at maximum pain instead of waiting for the trade to work. Now imagine Livermore's method with the exact same trader, the exact same market, the exact same setup. He buys 3 contracts at a support level. His intended full position is 9 or 10 contracts, but he only deploys 3. The other 6 or 7 will come later if confirmation appears. He sets his stop loss 20 pips below the entry. That's a hard number. $60 of risk. $60. That's a tank of gas. That's a decent dinner. It's not pleasant to lose, but it's not existentially threatening. Price falls. Even falls 15 pips. He's now down $45. He feels almost nothing psychologically. It registers as background noise. It's volatility. It's normal. His nervous system isn't flooded with cortisol. His amygdala isn't screaming. He can think clearly. He can wait. He can see whether the market is actually rejecting his thesis or just experiencing normal pullback volatility. Price recovers. Confirmation appears. The market validates his read. He buys 3 more contracts at a slightly higher price. His stop loss for all 6 contracts moves to break even on the first entry, or perhaps 15 pips below the new entry. Now he's risking $90 total. $90 on a position that's twice as large. But here's the critical part. He's less worried because his average entry is better. He bought the second tranche higher, which improved his average, and momentum is on his side. The market is validating his thesis in real time. His conviction is building. His psychology is protected. This is the psychological architecture that Livermore mastered. Smaller individual stops create larger tolerance for volatility. It's counterintuitive. You'd think smaller stops would create more anxiety. You'd think being more exposed to being stopped out would make you more nervous. But it's the opposite. Smaller absolute dollar risk on each tranche means you can psychologically absorb volatility. You can hold through normal market noise. You can wait for confirmation. You can let trades work. You're not constantly on the edge of panic. But here's the critical rule, and this rule separates professionals from amateurs more clearly than almost anything else. If the first 1-3 is stopped out, the trade is dead. Period. You don't add the second 1-3. You don't hope the market will recover. You don't average down. You don't deploy more capital to salvage the position. The trade is dead. You cut it, and you move on. This is non-negotiable. Most traders violate this rule constantly. They lose on the first entry. Then, instead of accepting that the market rejected their thesis, they add more capital to the second entry, hoping to average down and recover. That's how amateurs turn a $500 loss into a $2,000 loss. A failed first 1-3 is data. It's the market saying your read is wrong. When the market says your read is wrong, the correct response is to listen. The correct response is to accept the loss and move to the next signal. The correct response is not to double down and hope. Livermore's personal diaries, the ones that survived and were studied, are filled with statements that make this crystal clear. I took the loss on the first probe. The tape told me I was wrong. I accepted the loss and waited for the next signal. He never chased losing positions with additional capital. Never. Not once in his diaries does he describe averaging down into a losing trade. He describes taking losses and moving on. He describes letting winners run. He describes cutting losers fast. This discipline is what built his legendary wealth. The stops in a 1-3 system must be mechanical. They must be automatic. No exceptions. No negotiations. No, well, maybe I'll give it one more candle. No, but the fundamentals are still good. No emotional reasoning. If the first third hits its stop, the entire position idea is rejected. The hypothesis was wrong. The market said no. You accept that and move forward. Here's the profound insight that changes everything. You don't make money by being right more often. You make money by risking less when you're wrong. This is the core maxim. This is what Livermore understood that most traders never grasp. Most traders focus on win rate. They want to be right 60% of the time, 70% of the time, 80% of the time. But Livermore knew that win rate is secondary. What matters is what you risk when you're wrong versus what you make when you're right. The 1-3 method enforces this mathematically. Your first wrong trade, the one where the first 1-3 gets stopped out, costs you exactly 1/3 of what a full-size wrong trade costs. If you were going to risk $500 on a full position, the 1-3 method means the first loss is $60. Your first right trade, the one where the first 1-3 works and you scale into the second and third, earns you the momentum to profitably add more capital at better prices. You're making more on winners and losing less on losers. Over 100 trades, this compounds into massive wealth accumulation. This is why professionals sleep at night, not because they're always right, not because they never lose, but because the 1-3 method caps downside per entry. Even if all 3 entries hit their stops, which is rare if your confirmation gates are working, the total damage is manageable. The portfolio can absorb it. The account can survive. The trader can emotionally recover and move to the next opportunity. There's no catastrophic loss. There's no account blowing drawdown. There's just small, manageable losses that get absorbed into the cost of doing business. An amateur trader with a blown-up account is done. He has no capital left. He has no confidence left. He has no belief in his system left. But a professional trader who took 3 small losses and moved on, he's still in the game. He's still alive. He's still searching for the next confirmation signal. And when it comes, he'll be ready to scale in methodically, with the same discipline, with the same rules, with the same mechanical stops. This is the difference between trading as gambling, where you hope to be right and panic when you're wrong, and trading as a business, where you accept small losses as the cost of identifying winners and scale into those winners with precision. The 1-3 method with mechanical stops transforms trading from the former into the latter. It's not glamorous. It won't make you rich overnight, but it will make you rich, consistently, over time, if you have the discipline to follow the rules and cut the losers when the first 1-3 hits its stop. Theory is beautiful. Execution is messier. The gap between understanding a principle and actually applying it in real time, under pressure, with capital on the line, that gap is where most traders fail. They know the rules intellectually. They can recite the strategy. But when the market starts moving and the tape starts printing, they abandon the system and revert to emotional decision-making. Livermore was different. He didn't just understand the 1-3 formula. He lived it. He executed it with ruthless consistency. Let me show you exactly how he applied it in real time, using what he obsessively called reading the tape. He'd watch the ticker symbol. Hours every day, sometimes days in a row on a single stock. A stock would fall into weakness, then stabilize, then begin to show signs of gathering strength. Eventually, it would break to a new support zone, a level where prior demand existed, where big money had accumulated. Livermore knew from his prior analysis, from his study of the tape, that if price held at this support level, the stock could rally $2 or more. $2. That was the target. That was the potential reward. But, and this is crucial, he didn't buy the full $2 expected move all at once. He didn't commit his entire intended position size in hopes of capturing the whole rally. He bought 1/3, just 1/3, 3 contracts instead of 9. And then he watched. Within seconds of that first 1-3 entry, one of 3 distinct things happened. The market voted. The tape delivered its verdict. Tape shows strength. This was the green light. Immediate buyers appeared on the bid. Real participation. Volume increased sharply off the support level. The stock bounced half a point or more. The tape was saying demand is real. This was confirmation. Livermore didn't hesitate. He added 1/3 more. 6 contracts total now. His conviction rose because the market was validating his read in real time. He was now 2-3 in at a better average price than if he'd bought all at once at the original support level. He was committed. But he was committed because the market had voted yes, not because he hoped it would vote yes. Because it did. Tape shows hesitation. This was the yellow light. Price held support. It didn't break down, but it didn't rally either. The bounce stalled. Volume shrank. The buyers who appeared on the initial bounce disappeared. The tape was saying demand exists, but it's not strong enough yet. Livermore didn't add. He didn't force it. He waited. He might wait 5 minutes. He might wait 20 minutes. He was watching for a second window where the tape would clarify. Either volume would return and price would break higher, or the tape would turn negative and he'd exit. But he didn't add capital into hesitation. That's amateur behavior. That's throwing money at the market and hoping it sticks. Livermore was a scientist. He waited for evidence. Tape shows weakness. This was the red light. Price pierced below support on increasing volume. Sellers overwhelmed buyers. The tape was printing aggressive selling. This meant the hypothesis was wrong. The support level wasn't real. Big money wasn't actually accumulating here. The first 1/3 stopped out immediately. Livermore took the loss, $60, manageable, survivable, and he was out. He wasn't damaged. He wasn't emotionally destroyed. He was alive to the next trade. The tape had spoken. He had listened. He had acted. This real-time decision tree is where most traders fail catastrophically. They don't listen to the tape. They don't read the market feedback. They commit to a thesis, I think this stock will rally, and then they ignore all contrary evidence. Price stalls. Volume shrinks. The tape screams this is wrong. But the amateur trader is committed. He's emotionally invested. He's hoping. He's praying. He holds. He adds. He throws good money after bad. Livermore did the absolute opposite. For him, the market was always right. Always. His job wasn't to be right. His job was to agree with the market in thirds. When the market said strength, he bought the second tranche. When the market said hesitation, he waited. When the market said weakness, he exited. He was reactive, not proactive. He was responsive, not stubborn. Here's the execution rule that made this work. After you place the first 1-3 entry, set a timer for 3 to 5 minutes. That's your window. In that window, one of 3 outcomes must appear. Strong follow-through with volume expansion equals add the second 1-3. Hesitation or sideways consolidation equals wait, and potentially reevaluate if the tape doesn't improve. Failure with volume-driven breakdown equals cut the position immediately. No limbo. No indefinite waiting. No, I'll just hold and see what happens. 3 to 5 minutes. You get clarity in that window. If you don't, if the tape is ambiguous, you wait longer, or you exit. But you don't sit in purgatory hoping the market will eventually come around. This is where amateurs differ fundamentally from professionals. Most amateurs leave orders hanging indefinitely. They enter a position. They set a stop loss. And then they wait. And wait. And wait. Days go by. The tape is unclear. Price oscillates. Volume shrinks. But they're committed. They're patient. They tell themselves patience is a virtue. So they hold, hoping the market will eventually agree with them. This is how you bleed capital. This is how small losses become medium losses, and medium losses become account-destroying losses. Professionals do something completely different. Professionals give the market a specific window to confirm. 3 to 5 minutes. That's it. If the tape doesn't show strength in that window, they either wait longer with reduced position, or they move on entirely. They understand that capital is finite. Time is finite. Opportunity cost is real. If this trade isn't working, maybe the next one will. Maybe the market is sending a signal that says not today. Maybe the correct decision is to preserve capital and wait for a clearer setup. The 1-3 method forces decisive feedback loops. You're not married to a thesis. You're not emotionally committed to being right about this one stock. You're married to price action. You're married to what the tape is actually showing, not what you hoped it would show. This is a fundamental inversion of control. The amateur trader controls his decisions emotionally. He decides to hold or add based on his beliefs. The professional trader lets the market control his decisions. He responds to what price action is showing. Big difference. Enormous difference. Livermore's greatest trades, the ones that made him millions, came from this ruthless discipline. He would enter 1-3. Read the tape for 3 to 5 minutes. Identify which scenario was unfolding, strength, hesitation, or weakness. Then he would scale, wait, or exit. With conviction, not with hope, not with hesitation, with data, with cold, objective market feedback. Let me give you a real example from his trading logs. A stock breaks into support. Livermore enters the first 1-3. 3 seconds later, buyers appear. Volume expands. Half a point up. 1 minute passes. Another point higher. Volume still strong. 2 minutes. Price is up 1.5 points from his entry. The tape is clear. Strength. He adds the second 1-3. Now 6 contracts. Average entry is better because he bought higher. 3 more minutes pass. Price consolidates briefly. Volume is still elevated. Not accelerating, but holding. Tape says still strong, just pausing. He doesn't panic. He waits. Minute 7. Price breaks to a new high. Volume spikes again. Clear confirmation. He adds the final third. 9 contracts. Full position. From entry to full position was 7 minutes. 7 minutes of watching price action. 7 minutes of listening to the tape. 7 minutes of letting the market validate his thesis in real time. And it worked. The stock rallied $2 as he predicted. He captured the entire move, scaling in properly, never adding to weakness, never panicking, never deviating from the system. This is what real execution looks like. This is what separates legends from casualties. We started this journey with a brutal truth. Hesitation kills trades. Amateurs hesitate at entry, and by the time they act, the move is half over. Capital is wasted on mediocre entry points. Profits are left on the table. Opportunity evaporates. We end with an equally brutal truth, one that's equally important and equally misunderstood. Hasty entry kills accounts. Rushing in without confirmation, committing full capital to unproven hypotheses, acting on emotion instead of evidence. This is how traders blow up. This is how 5-figure accounts become zero. This is how professionals become casualties. The 1-3 formula bridges that gap perfectly. It's not hesitation. It's not haste. It's disciplined speed. It's moving fast, because you have a system, not moving fast, despite lacking one. Let me close the loop from the opening of this entire video. Livermore didn't beat the market by being smarter than other traders. He didn't have access to better information. He didn't have some secret indicator or proprietary algorithm. He beat the market by having better rules. Rules that removed emotion from decision-making. Rules that honored price action instead of ego. Rules that scaled winners automatically and amputated losers mechanically. The 1-3 method is one complete rule set. It's not the only system that works. But it's a system that does work, consistently, if applied with discipline. Here's exactly how to use it immediately, starting tomorrow morning when you open your charts. Enter its structure, not hope. This is foundational. Wait for a retrace into support. Don't buy because price is going up and you're afraid to miss the move. Don't buy because you feel optimistic about the stock. Buy when price retraces into a prior demand zone where big money has accumulated. The first 1-3 enters at or very near support with a tight stop loss set 20 pips below the prior swing low. This is your probe. This is your hypothesis test. It either works or it doesn't. If it works, you'll know within minutes. The tape will show strength. Volume will expand. If it doesn't work, you take the small loss and move on. But you're not entering on hope. You're entering on structure. Confirm with breakout and volume. The second 1-3 enters only when price breaks above the swing high that caused your initial retrace. That breakout is your confirmation. Until that breakout happens, you wait. No exceptions. Volume must expand on the breakout too. A breakout on shrinking volume is a trap. A breakout on weak participation is noise. If the breakout happens and volume expands, add the second 1-3. If the breakout doesn't happen, you wait longer. If the breakout fails and volume shrinks, you exit the first 1-3 entirely. No breakout equals no second entry. No expansion equals wait longer. This rule eliminates guesswork. Validate with time. The third 1-3 enters after 2 to 3 candles of sustained structure above the breakout level. Not one candle. Not immediately. 2 to 3 candles. This proves that the move isn't just a one-candle spike. This proves that structure has actually shifted. Price is holding above resistance. Buyers are in control. Momentum is building. Only then do you add the final tranche. Patience here prevents pyramid collapses. Patience here ensures that you're building position into real moves, not chasing false breakouts. Reject failed entries ruthlessly. This is non-negotiable. If the first 1/3 stops out, the trade hypothesis is wrong. The market has rejected your read. You don't add the second 1/3 hoping to average down. You don't add on dips hoping to salvage it. You stop. You pause. You accept the small loss. You move to the next signal. This single rule prevents amateur traders from turning small losses into account-destroying losses. This rule keeps you alive. Cap your total risk per position. Even with 1-3 scaling, even with all the psychological protection the method provides, your maximum position size should never risk more than 1 to 2% of your total trading account per trade. If you have a $10,000 account, the maximum loss on any single trade should be $100 to $200. This way, even if all 3 entries are wrong, which is rare if your confirmation gates are actually working, you survive. Your account absorbs the loss. You move to the next opportunity. You don't blow up. These 5 rules are your operating system. Apply them. Live them. Let them become automatic. They're not suggestions. They're the difference between sustainable wealth building and catastrophic account destruction. Now, let me reframe Livermore's greatest maxims through the lens of 1-3 scaling, because these maxims are where strategy becomes philosophy. The tape tells the story. Listen or lose. The 1-3 method forces you to listen. Every single entry is a question to the market. Is this move real? Price action answers. You respond. The tape isn't some mystical force. It's real-time market feedback. It's buyers and sellers voting with their capital. It's volume participation. It's momentum. If you listen to the tape will tell you when to add and when to exit. If you ignore the tape, you'll add to weakness and exit at strength. You'll do everything backward. The 1-3 method makes listening mandatory because each entry requires confirmation from price action. Cut losses short. Let profits run. The 1-3 method achieves this mathematically, not emotionally. Small first losses prevent large portfolio damage. When your first 1-3 stops out at 20 pips below entry, you're down $60. That's small. That's manageable. That's not emotional damage. That's the cost of doing business. Meanwhile, when the first 1-3 works and you scale into the second and third tranche, profits accumulate. You're not capping your winners. You're not taking profits too early. You're letting them run by continuing to add on confirmation. The winners compound. The losers are small. Patience is a position. The 1-3 method trains this deep in your bones. Waiting for the confirmation gates to open. Waiting for the tape to show strength. Waiting for 2 to 3 candles of structure validation. All of this is active patience, not idle waiting. You're engaged with the market. You're watching. You're analyzing. You're ready to move. But you're not moving until the market confirms. This patience prevents premature entries. This patience prevents adding to false signals. This patience keeps you alive. The highest profits come from the fewest trades. Because your confirmation gates are tight, you take fewer total trades. Not every price movement triggers entry. Only setups with real structure, real volume, real-time validation trigger entry. This means your trade frequency decreases, but the quality of each trade increases. More of them work. Your win rate rises. Your average profit per trade rises. You make more money on fewer trades. This is the opposite of what amateurs do. Amateurs trade constantly, chasing every movement, taking low-quality setups. Professionals wait. They let the market come to them. They enter confirmed setups. They make money. The final truth that ties everything together, Livermore's 1-3 scaling formula, isn't flashy. It won't make you a YouTube sensation. It won't sell courses or seminars. It won't look good on CNBC. It won't get retweeted into viral TikTok fame. But if you apply it consistently, small position on initial signal, larger position on confirmation, full position on validation, your drawdowns will shrink. Your win rate will rise. Your mind will learn the discipline that separates amateurs from professionals. You'll start to think like a professional. You'll stop panicking on small losses because they're manageable. You'll stop getting greedy on winners because you have a system for scaling. You'll stop hesitating on entries because you understand that confirmation removes the guesswork. Hesitation isn't your real enemy. Hesitation is just a symptom of unconfirmed conviction. Your real enemy is unconfirmed conviction, committing capital to trades that the market hasn't validated yet. Your real enemy is hope. Your real enemy is thesis-driven trading instead of price action-driven trading. The 1-3 formula removes that enemy by making every single dollar you deploy count as evidence, not hope. Every entry is a test. Every confirmation is proof. Every scale is a response to market validation. You're not betting anymore. You're executing a business system. This is the insight that transforms trading from gambling into wealth building. This is the mindset shift that separates people who trade for a few years and blow up from people who trade for decades and compound millions. The 1-3 method, applied with discipline and patience, is the pathway from amateur to professional. It's not complicated. It's not secretive. It's not even particularly novel. Livermore was using versions of this method over 100 years ago. But it works. It works because it honors price action. It works because it removes emotion. It works because it scales winners and cuts losers. It works because it's simple enough to execute perfectly under pressure. Apply these rules. Trade the 1-3 method. Let the tape be your teacher. Let patience be your position. And let discipline be your wealth-building engine.